looking at United Airlines today, I mean, are we seeing a falling trend, flashing sell signals, or is this a strong buy that the market is, severely undervaluing right now?
That is the multi-billion-dollar question, isn't it? And honestly, it is the ultimate test of whether an investor is reading the actual data or, well, just trading on raw emotion.
Right, exactly. Welcome to today's Deep Dive. Today is Friday, April 17, 2026, and we are focusing exclusively on United Airlines Holdings, Inc., so ticker symbol UAL.
Yeah, we've got a lot to unpack with this one.
We really do. The mission today is to cut through all the market noise. We're going to analyze the raw financials, the charts, the underlying order flow, and those massive rumors swirling around to figure out exactly what is driving today's huge stock movement.
It's going to be a fascinating breakdown.
Oh, and a quick aside for you listening, please like the video, subscribe to our YouTube channel, and leave your comments and feedback below. It is compulsory for the algorithm, but, it also helps us know what you want us to cover next.
For sure. And the data really is our anchor right now because, the market is acting violently emotional.
Yeah, it's been a wild ride lately.
It really has. Over the last month, we've seen sentiment on airlines shift rapidly from this deep panic-selling fear to just extreme fear of missing out greed. And when emotions run that hot, the market tends to overreact in both directions.
Let's unpack the reality of that roller coaster, actually, because looking at the real-time quote, UAL is currently trading at $104.18. It's up $9.15 just today.
That's a massive move.
Right. That is a 9.62% jump in a single trading session. But for everyone listening, you can't just look at today's green candle and declare victory, because this is happening in the context of a fairly brutal recent 20% drop.
Exactly. And while it was triggered by some very heavy macroeconomic realities hitting all at once, we saw sudden spikes in jet fuel prices, which, as you know, immediately eat into an airline's margins.
Oh, jet fuel is basically their kryptonite when prices spike.
Precisely. And at the exact same time, new global tariffs were announced, which sent this wave of panic through the market that international travel demand, which is highly lucrative for United, was going to severely slow down.
And it's been a wild ride for the last year, even before those tariffs hit.
Yeah.
The 52-week range paints a picture of extreme volatility. We are looking at a 52-week low of $63.23 and a high of $119.21.
Right, a massive spread.
Yeah. So today's jump to $104 puts us closer to the top of that range, but it is technically a short-term recovery trapped inside a broader decline. It's like hitting a massive pocket of turbulence with that 20% drop. Now the pilot has, yanked the nose up.
That's a great analogy. The underlying trend direction is actually still classified as neutral to bearish on the macro scale.
Okay, neutral to bearish.
Right, but if we zoom in on the order flow for today, it tells a very specific story about human psychology and institutional positioning. We are seeing massive volume, and earlier this week, the buying was heavily clustered near the $88 to $90 support level.
So based on who is buying and selling at those levels, is this just a dead cat bounce, or institutions actually stepping in? It looks like they essentially drew a line in the sand.
Yeah, they watched retail investors panic sell down to $88, decided the stock was too cheap at that level, and stepped in to buy wholesale.
But as the price shoots up past $104 today, looking at the data, I am seeing serious selling pressure already stacking up as we approach the $116 to $119 resistance zone.
Which tells us that the institutional buyers who defended that $88 bottom aren't necessarily holding for, a long-term golden era of aviation.
They just want their quick payday.
Exactly. They're looking to take profits. They remember the sting of that 20% drop just as well as retail traders do. They see the resistance at $116, and they are preparing to offload shares to anyone chasing the momentum right now.
So the stock action today is fighting this immense gravity. And to understand why that gravity exists, we really have to transition from the daily stock ticker to the actual ledger. We have to figure out if this company is fundamentally healthy.
We should definitely start with the full year results for fiscal year 2025. They reported those on January 20th. At first glance, the income statement is a blockbuster. Total revenue hit an all-time record of $59.07 billion.
Oh, wow. $59 billion. That is massive demand. And it looks like it translated to the bottom line too, right? Net income came in at $3.35 billion, giving them a diluted earnings per share of $10.32.
Yeah, on paper, they're absolutely printing money. They're generating exceptional revenue from their core
But
operations.
there's a but coming, I can hear it.
Well, an income statement only tells you what came in and what went out during a specific window of time. The balance sheet tells you what the company is actually carrying on its back. Total assets sit at $76.45 billion.
Okay, sounds good so far.
Total liabilities are $61.17 billion, leaving total equity at $15.28 billion. But the glaring issue, the thing the market is so incredibly worried about, is the long-term debt. It's sitting at $20.18 billion.
Wait, $20 billion? That is a staggering number. I want to frame this for the listener because, $59 billion in revenue sounds invincible until you look at how it's being spent.
Right, it changes the whole picture.
It's like owning a beautiful $59 million mansion, but you have a massive high-interest balloon mortgage on it,
Yeah.
and the roof, which in this case is jet fuel, needs constant expensive patching. Does that massive debt load eat up too much of their free cash flow to make this a safe bet?
It acts like a total financial vacuum. Let's look at the cash flow statement to see exactly how that plays out. Operating cash flow is very strong at $8.43 billion.
Which is just the cash from selling tickets and flying passengers, right?
Exactly. But airlines operate on a brutal capital expenditure treadmill. They can't just pause spending. Their capital expenditure, buying new planes, upgrading the fleet to be more fuel efficient, heavy maintenance cycles, was negative $5.87 billion.
Okay, so 8.4 minus 5.8, which leaves about $2.5 billion. But I know their free cash flow is actually reported at roughly $1.1 billion. So that missing $1.4 billion is just, evaporating into debt servicing.
Essentially, yes. I mean, interest payments on $20 billion of debt are enormous, especially if any of that debt is floating rate or needs to be refinanced in today's higher interest rate environment.
That's a huge burden.
So out of a record-breaking $59 billion in revenue, the actual free cash flow, the pure unencumbered cash the company has left over to weather a storm or pay dividends or buy back stock, is just $1.1 billion.
So even with $1 billion in the bank, that $20 billion debt load acts like a gravity well on the stock price. And when you look at the charts, you can actually see traders fighting that exact gravity today. Let's shift to the technical analysis because the indicators are flashing some wild signals right now.
The technical framework is moving incredibly fast today. Let's start with momentum. The RSI, the Relative Strength Index, is currently at 52.95.
And for those listening, think of the RSI like a stock speedometer. It tells us if the stock is being bought too fast or sold too fast. Right now it's at 53, which is basically cruising speed. It's totally neutral.
Right, but with today's 9% jump, I imagine that speedometer is accelerating hard toward the overbought red line in the short term.
Oh, absolutely.
And we see that acceleration confirmed in the MACD, the moving average convergence divergence, which is currently at 1.03.
And the key there isn't just the number, right? It's that the MACD just flashed a bullish crossover today.
Exactly, meaning the short-term momentum of the price just aggressively overtook the longer-term momentum. The stock isn't just moving up, the pace at which it is moving up is accelerating.
Which forces mechanical traders to buy.
Yeah, and this acceleration caused the price to shatter some major technical ceilings today. UAL surged above its 50-day moving average, which was sitting at $99.75.
A clear buy signal.
Right, and then it kept going and made a sustained move above the 200-day moving average at $100.27. When a stock crosses both its 50-day and 200-day moving averages on high volume, like we are seeing today, algorithmic trading bots and technical traders see bright green buy signals.
Okay, I have to challenge this because this is where listeners can get trapped. We established earlier that the overall macro trend for UAL over the last few months is neutral to bearish.
Yes, we did.
But today, the MACD has a bullish crossover, and the stock breaks the 50 and 200-day moving averages. How should a listener reconcile negative medium-term signals with a highly bullish short-term outlook?
That's a great question. You really have to separate the weather from the climate. The medium-term trend is bearish because of the macro factors. You know, the $20 billion debt, the global tariffs, the volatile fuel costs.
The heavy luggage.
Exactly. But the weather today is violently bullish. A moving average crossover just means the average price over the last 50 days was lower than the price today. In a highly volatile stock, a single 9% surge can mechanically force those averages to cross, even if the fundamental health of the company hasn't changed overnight.
So it's a momentum signal, not necessarily a value signal. But Wall Street analysts seem to be ignoring the climate entirely. The consensus analyst rating across the board is buy or strong buy.
Yeah, they are very optimistic.
I have an average price target of $130.17 with some aggressive high targets up at $156.
Analysts tend to heavily weight those record revenues and projected earnings out 12 to 18 months. They look at the company's earning power and just assume the macro headwinds will eventually die down.
Which brings us to the ultimate debate for the listener. With analysts projecting $130 and the chart flashing technical buy signals, this looks like an undervalued gem. But if it were that simple, institutional money wouldn't be queuing up to sell at $116. Let's debate this. Is this a true value play, or is this a classic value trap?
Well, the undervalued argument relies heavily on the earnings multiple. UAL is currently trading at a PE ratio of 9.3x.
Which is incredibly cheap. A PE of 9.3x is like buying a first-class ticket for an economy price, but is the plane broken? Are retail investors just catching a falling knife because they see a discount?
You do have to grade airlines on a curve. They historically trade at lower multiples because they are heavily cyclical and, highly vulnerable to things entirely outside their control, like geopolitical events or oil supply shocks.
Right, things they can't manage.
But even for an airline, 9.3x is historically cheap, especially considering they just posted the highest revenue in the company's history. And management clearly agrees the stock is undervalued because they bought back $29 million in shares in the fourth quarter of 2025.
Which is the ultimate signal of insider confidence. They are using their precious free cash flow to buy their own stock instead of paying down debt.
But that is exactly what creates the value trap. The trap is buying a stock solely because the PE is 9.3x without realizing why it's so heavily discounted in the first place. The market is pricing in risk.
The downside risks are real.
Very real.
Oh.
That $20 billion debt load becomes exponentially more dangerous if global tariffs trigger a genuine recession and business travel dries up. If revenue drops, those interest payments certainly don't.
Plus the input costs. We mentioned the capital expenditure treadmill earlier. Airplanes are getting more expensive, labor unions are securing higher wages, and upgrading the fleet is draining cash. The risk is that the $1.1 billion in free cash flow eventually shrinks to zero.
And this is exactly why retail traders often get financially slaughtered in these setups. Retail psychology is fascinating and honestly highly predictable. A month ago, retail investors were terrified of tariffs and fuel costs, so they panic sold the bottom at $88.
Driven totally by fear.
Yes, and today they see a massive 9% daily surge. Their sentiment shifts instantly from fear to greed, the fear of missing out.
They see the green candles, they read a headline about a buy signal, and they jump in at $104, completely ignoring that institutional sellers are waiting to dump shares on them right at the $116 resistance level.
Exactly. They are buying the top of a short-term momentum bounce.
And if the momentum fades before breaking that resistance, the stock bounces hard off the ceiling, and those retail buyers are left holding the bag as the price drifts back down into its medium-term bearish trend.
It happens all the time.
So, having laid out the trap potential, we now need to map out the two divergent paths the stock could take from here. The short-term outlook, meaning the next few days to weeks, is undeniably bullish. Part of that is driven by some immediate relief in oil prices over the last 48 hours, which gives their operating margins some breathing room.
Yeah, but there is a massive elephant in the room driving today's greed.
The rumors.
The merger rumors. The market is currently flooded with speculative rumors about a potential merger between United Airlines and American Airlines.
I have to jump in on that because logistically, that sounds like a regulatory nightmare.
Yeah.
A merger between United and American would create a domestic monopoly of unprecedented scale. The DOJ would almost certainly fight that tooth and nail under current antitrust doctrines. So why is the market aggressively buying a rumor that might never legally happen?
Because in the short term, the market trades on the possibility of a premium, not the probability of regulatory approval.
Ah, I see.
If a merger were formally announced, American would likely have to buy United shares at a significant premium to today's price. Traders are buying the stock today, hoping to capture that immediate pop in value, regardless of whether a judge blocks the merger 3 years from now. It is pure speculative frenzy.
But the rumor mill is going to hit a brick wall of reality very soon. The ultimate catalyst is staring us right in the face. UAL reports their next earnings on Tuesday, April 21st, 2026.
That is the defining binary event for this stock. Earnings calls strip away the rumors and force the market to look at the actual math for the first quarter.
April 21 is just 4 days away. We have massive merger rumors floating around right before an earnings call. That feels like a powder keg waiting for a spark. Management is going to have to address these rumors on the call, along with providing forward guidance on how the tariffs are actually impacting their advanced bookings.
And if we look beyond next week's volatility, The medium to long-term outlook really relies on management strategy. United isn't just playing defense, they are aggressively driving strategic network expansion, specifically increasing capacity at their major hubs in Washington, Dulles, and Houston.
Trying to grow their way out of the problem.
Yeah, they are trying to capture a larger share of high-margin international and premium business travel to outrun their debt costs.
All right, let's synthesize this for the listener into two clear paths. What does the ultimate bull case look like from here?
The bull case is a best-case recovery scenario where the macro fears prove to be overblown. Fuel costs stabilize at a lower level, global travel demand remains persistently high, completely ignoring the noise around new tariffs, and most importantly, on April 21, management beats earnings estimates and provides strong forward guidance.
So a total fundamental win.
Yes. In that scenario, this short-term momentum validates the technicals, the stock breaks forcefully through that $116 resistance, and begins a legitimate march toward the analyst targets of $130.
And the bear case? The worst case continuation lower where this 9% jump is just a trap.
The bear case is a scenario where the earnings report on Tuesday shows that new global tariffs are indeed choking international demand. Management gives weak forward guidance. The merger rumors are completely dismissed as fiction.
Which would crush the speculative momentum.
Exactly. The market realizes that the $20 billion debt load is suffocating free cash flow, and input costs for fleet upgrades spiral out of control. The technical momentum completely fails, the moving averages cross back down into a sell signal, and the stock rapidly tests that $88 support level. If that floor breaks, the next stop is significantly lower.
It's a precarious spot to be in.
It really is. And before we wrap up, it is absolutely critical to remind you, the listener, that this deep dive is strictly an educational analysis of the data and natural human debate. Absolutely no financial advice is being given here today.
Always crucial to state.
You must always do your own research, understand your own risk tolerance, and consult a certified financial professional before making any investment decisions.
Well said. So a brief wrap-up of the conflicting forces we've discussed. UAL is a literal battleground. On one side, you have record revenues of $59 billion and a cheap valuation battling against heavy debt, tariffs, and volatile fuel prices.
It is the ultimate tug-of-war between fundamental earning power and macroeconomic vulnerability, amplified by the psychology of retail traders chasing momentum.
Which brings us back to the multi-billion-dollar question we started with. I want to leave you with this final provocative thought to mull over. If the merger rumors with American Airlines turn out to be nothing but smoke and mirrors intentionally floated just days before the April 21 earnings report, does this sudden 9% surge become the ultimate value trap for retail investors? Let us know what you think in the comments.